Meta Platforms stock could in time attain a higher multiple. Meta Platforms shares have nearly tripled from their 52-week low, but it may be wrong to say that shares have gone from undervalued to overvalued. The Facebook and Instagram parent has a lower valuation range among Magnificent Seven stocks, indicating room for multiple expansion. With this, let's explore how Meta Platforms stock over time could attain a much higher forward earnings multiple. Let's dive in. Here's how Meta Platforms stock could narrow a magnificent valuation gap. Welcome to Timely Investment Research. If you bought Meta Platforms shares earlier this year, chances are you aren't complaining. Meta Platforms stock is up by over 168% year-to-date and has nearly tripled from its 52-week low. But for those who have dived into the Facebook and Instagram parents' shares more recently, instead of no complaints, you may be feeling frustration and concern regarding this leading tech stock. Since the summer, Meta Platforms has more or less traded sideways as investors digest various fears, uncertainties, and doubts. Some are laying out bearish arguments about Meta Platforms' performance in the months year ahead. However, it's far from a lock that less stellar returns are just around the corner. In fact, beyond just from the reporting anticipation of continued earnings growth, shares could rise for another reason in the medium and long term. It all has to do with Meta Platforms' relatively lower valuation compared to many of its peers. Why Meta Platforms stock has yet to become overvalued. In late 2022, Meta Platforms was trading at a price-to-earnings ratio in the low teens. This put shares well within value stock territory. You can no longer buy Meta Platforms at such a bargain basement valuation, but while no longer undervalued, this stock isn't overvalued either. One reason is that Meta Platforms stock trades at the lower end of the valuation range compared to the Magnificent Seven stocks. As you may know, the Magnificent Seven are the 7 tech stocks that play an outsized role in driving the movement of the broad market. Apple, Amazon, Alphabet, Nvidia, Microsoft, and Tesla are the other 6 stocks in this category. Of this group, Tesla and Amazon are valuation outliers, with forward PEs of 75.1 and 55.6, respectively. Apple, Nvidia, Microsoft trade at forward multiples between 30 and 40. In the case of Meta Platforms and Alphabet trade at around 23 to 24 times earnings, significantly lower than their peers. Admittedly, there are some solid reasons a valuation discrepancy exists. Even so, there's still a path for this gap to narrow. A justified discount? Maybe not. It goes without saying why neither Meta Platforms stock nor Alphabet stock trades at a multiple on par with Tesla or Amazon. These companies, at least in the minds of the market, have strong potential to report extremely high levels of earnings growth over the next few years. When it comes to why Meta Platforms and Alphabet trade at discounts to, say, Apple, Microsoft, and Nvidia, the fact both these companies have advertising-focused revenue models explains much of it. The cyclicality of advertising demand suggests a greater level of earnings cyclicality. With Apple, Microsoft, and Nvidia's revenue models product subscription-focused, perceived certainty about future results is much higher. Nevertheless, while a valuation discount is warranted, is the current discount justified? Maybe not, as it may be too wide. Chances are this overly wide gap won't correct on its own, through some sort of valuation is its own catalyst type of scenario. However, the respective AI catalysts for Meta and Google could help to bridge it. I'll save a more detailed discussion about how AI could help re-rate to the upside for another video. But here is how exactly Meta's AI catalyst could lead to a substantial re-rating for its shares. This one pivot could make all the difference. Ongoing economic challenges could lead to lower than expected digital advertising demand next year. However, Meta's effective use of AI to increase ad revenue from its existing social networks, plus the launch monetization of new ad-supported applications like Reels, may outweigh any re-softening of demand. Better yet, beyond just improving Meta's existing revenue model, the company could also turn its AI breakthroughs into new revenue streams. Similar to how Apple has been re-rated thanks to its pivot towards a services-based revenue model, a pivot away from strictly advertising-based revenue model may enable Meta Platforms to move toward a forward valuation in the high 20s, low 30s range. Taking this into account, if you're an existing Meta Platforms stock investor and have been mulling whether to take profit, give it some more thought. If you've been hesitant to buy given fears of a sell-off, let my argument help to assuage your concerns. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, Hit that bell icon to never miss an upload, and hey, don't forget to subscribe.